Sorry for the slight delay. Marlon, thank you very much. You're working busy in the background on a bit of technical problems, but we can get started. Thank you for hanging in. What I thought I would do, I'm not sure how many of you sat through the trading retreat last week, but Paul asked me to share briefly on measured moves because that's something that I used extensively in price action trading. So I just thought the month is beginning, first day of the month. Let me just take the time to take you through measured moves in a little bit more detail, and hopefully you can use them in your trading. So if you can, as much as you can as this month unfolds, just try looking for these measured moves. They really are useful for many things. One of the things that I use measured moves for is to show me where price is likely to react. By react, it may bounce off a level or it may break through a level. Okay, so I'm prepared for that. If I'm in a trade, I can take a decision depending on the level that price is reaching, whether to stay in the trade or to take my profits. If I'm not in a trade, I can use a measured move to see if on a failed test, I can get an entry into the market, or if a breakthrough, I get a pullback and enter the market. So those are very good uses of measured moves. There are a few others, and I'll show you as we go along, but primarily is for us to be aware of where price is likely to react by either testing and failing or breaking through and then having a confirmed breakthrough. Two types of measured moves. One is simply based on the height of a trading range, whatever form that trading range comes in. The other is when you're in a trend, when you get the first move of the trend up or down, the market then pulls back. Typically, if the trend is strong, there will be another leg of the same height as the first move. So as we go through, you'll be able to see that. So pop in any questions that you may have, but I am using the Hang Seng 50, which is one of my favorite markets, one of the markets that I trade off the 5 minutes. So there are two markets that I just come into the market in the trade of the 5 minute. That's the Hang Seng 50 and the DAX 30, the German 30. Then the rest of the markets depend on where they are on the daily. But let's just focus on the Hang Seng 50. Interesting because it has a distinct open after the market has been closed for 6 hours and 15 minutes. So that's a beautiful open to trade because you do get clear price action. In any case, so looking for measured moves. We're not going to worry much about the actual price action. Bear trend, pull back. Now, every time you see a bear trend, a trend of any sort, and a pullback, you've got to be saying to yourself, if the guys who created the trend are strong, then they are going to be wanting a second move. Okay, so let me show you something. So when I find how far the market is likely to go, okay, you use Fibonacci Expansion, and we click on the beginning of the visible leg we see. There is first leg, then the end of the pullback, first leg pullback. So if the bears were strong off this particular move, you'd be expecting them to come and get to a measured move. What is this level here? So this level is a level that I marked off the monthly time frame. I looked at the all-time high and also the all-time low. Then the midpoint of that is a 50% midpoint all-time range. So that is a strong magnet. If the market is above it, there is a strong magnet that's going to try and pull the market down. Okay. So at that point, to be saying, I wonder if the bears are going to get to this extent, okay, this far. Now, that's a leg one pullback, leg 2 extension. It is a measured move. This distance here is exactly the same distance we have after the pullback down here. Okay, so that is a measured move extension. Another way to work out a measured move is just to simply look using again a Fibonacci tool, but this is a Fibonacci retracement. You go to the low or the end of the move, you go back to where it started. That's where the move started. And using just the height of the breakout without worrying about the pullback, the bears would like to get to there. That will be the objective of the bears, okay, to get down to here. So if you are taking a trade and if you're going to hold out and hope that the trade gets all the way down here, whatever trade you took in here, so if you took an early trade, your stop is up here. If you took a trade here on the pullback, your stop has to be at the 50% of the pullback at least. And you are hoping at that stage that the market will get either to the extension or to the full length of the breakout down here. Now, having seen that, of course, you manage your trade. And if you then see the market bouncing off, creating a reversal, you get out of your trade. Okay, so that trade, you've got now break even, anything out of there, a bit of profit before you get stopped out. But the point is not to worry at the moment about profits and losses, but to work out these measured moves. Okay, now I've just shown you, let's call it measured moves that you can easily see. Okay, that's what you must be placing in. As you start to read the markets a little bit closer, you will start to notice something else. Okay, so as you are practicing, this is what I encourage you to do as you are practicing. Just pull out any chart, look for these trends, whether it's a bear trend or a bull trend, and see where the market would like it to go. But as we dig further into price action, as you get to understand it more and more, when you are in the market from the open, and then you see this huge bull candle, and a doji follows. The doji could be any color. It could be a bear trend, it could be a bull doji, it could be a perfect doji. You know that after this breakout, the market has paused. That to be a pause, because that one bar trading range has the same strength and same force as a pullback like that. Okay, it's a pause, it's a doji, it's a trading range, so the market is pausing and pulling back. Now, once you start to look out for those as well, you then say, but hang on a second, now you're in the market, all of this hasn't happened. We've gone that far up to the time we had the pause, the doji. Okay, that's where the trend started. So now I can expect that after the pullback, the bears want to make a full measured move. Okay, and the bears got their measured move after that pause. So that first leg, pause and extension, market go to that exactly. You could still use this other tool, the extension. Okay, and this is how you'd use it. Insert Fibonacci expansion. So market started there, and you are live in the market and say, hang on, we've now got a doji candle right here. And that's it. That's where, okay, let me put it in. That's the low of the leg at the end of that huge bear candle. And the end of the pullback is the height of that doji. And you're saying, okay, if I take a trade there, because of that breakout, I can just sell at the market. My stop has to be up there. I'm expecting the market to get to the measured move. So you can see that the market got, let me delete some stuff. Yeah, delete some stuff. Let's delete this one. Can always put these things back. So that's the larger one. So now you are in the market on the day from the big breakout, doji, you know, that's a pause because that's it's a doji candle, it's a trading range. And we have to be aware of these things. We can't ignore them. It's not noise, it's information that's coming to us. It's telling us that the market paused right there. So first leg, pull back to the top of the trading range, the donji, and you expect the market to get there. So you can take any trade here and get your one-to-one. Alternatively, you could have used this tool here, which we had deleted. You could have used this tool here, Fibonacci replacement, the retracement, and say that's the low of that first move. That's the high. Where do I expect the bears want to go? You expect them to get here. So you got to be looking to take profits somewhere between these two. And if you're in a trade and you see that, don't be surprised. Say, hang on, what's happening to all of this bearish price action? The bears have achieved their objective. So if you had taken that trade, which you could have, one of our strategies, you get here, just close the trade immediately, bank your profits. Okay. Alternatively, if based on your other assessments, if you're expecting that the market is going to go low, remember now I've just opened the 5-minute, I haven't looked at the daily to see if we're in a bad trend, whatever. If you're expecting the market to go low, then just hold and see what we get. We might have a trading range and then break out. Okay, so that's a pretty good use of measured moves. In a strong trend like this, have a look at it and say, is there a doji? Is there a pause anywhere? I mean, we'll talk when we get here and I'll show you where that is. But these measured moves start to give you information. The market is not random. The things that are appearing in front of you in the chart is all information that we can use to take trades or otherwise, or exit trades. In other words, manage our trades. So we got a higher low double bottom here. Okay, then always look for the third opportunity to get in the market. There is a third opportunity to go long. Okay, now this red line was the low of the previous day. Green line is the high of the previous day. Bears broke out here pretty strongly. Fantastic, pulled back, but they failed to have follow through. So if you any trades, you must get out here. If you haven't gotten out at all, you must get out here. Now you've got to be thinking of going long. Then anytime you see any form of a trading range. Now a trading range is not necessarily just a square or a rectangle, because too often we think, oh, that's a trading range. Okay, yes it is, but that's not the only form of a trading range. Anytime you see a low, a high, and the market coming back, that pattern is a trading range. Okay, it's an area of agreement. We're down here, went up, disagreed, came back. And anytime we then have a breakout of a trading range, we are expecting a measured move. Okay, whoever has the strength to break out of the trading range clearly will be saying, I want to get a measured move of that trading range. Okay, so there's a trading range. We click on this tool here and mark the height of it, because now we're going long. We start from the direction you want to go long, start from the high. From there to the low. Okay, so whoever breaks out above this, their goal is to get to that level. That's their goal. Now, remember when you say breakout, we want to see a confirmed breakout, which means we want to see a breakout candle and we want to see a follow through. We had a breakout candle, but we didn't get the follow through. So now in your mind, you're going to be saying, but hang on a second. Bears were strong, failed to have follow through. Okay, they failed to break in this low. Bulls have created this pullback and this pullback. They have an opportunity to break out above that trading range. 1, 2, 3. But we look at the actual breakout, the candle breaking out. Good. Why don't we have follow through? So immediately you must know, okay, I still have my measured move there. The bulls are not strong enough to follow through. So I'm expecting more trading range price action, because the bulls controlled it, but they failed to break through. Bears controlled this, they failed to break to the low. So it's an area of agreement, two-sided price action I can expect. Also, if the bulls had been strong enough to break out and follow through, their objective is to get to here, which is still below the low, the open of the day. So it would mean on the day we opened here, sold all the way down. If the bulls had been strong and got here, we'll just have a tail on the day up to that point, okay? Which will still mean huge trading range price action. But having seen that, you still have the double bottom, right? You see that the bulls have controlled the market. They failed to broken through. That's one. That's two. You're still waiting for a way to get into the market. And you should be able to get in here. Okay, we're not looking at that today, but that's the third push I'm always talking about. 1, 2, 3, entry into the market to go long. So you take that entry, the stop has to be down here. Now, you're now saying, okay, I've taken that entry. My anticipation is that the bulls are still going to break out. Okay, but if they do, what is the goal of the bulls? We have a high, we have a low where we're taking our trade. So you're saying if the market breaks out of that forming trading range, okay, if the bulls are able to break out of the get up here, so you're still here, if we're able to get up here as bulls and break above that, that is the objective. Now you say, hang on a second, all of a sudden, things are changing in the market here. Because at this point, the bulls created this trading range. Why do I say that? Because the bears were strong and the bulls, created a pullback. Bears failed to even have a perfect double bottom or slight breakout beneath. So bulls came back, huge bull candle. Okay. Then the bears tried again to break to the downside. Once, twice, 3 times. The bears have failed. Okay. And now the bulls turned the market here and created even followed through a micro double bottom. So you could have bought here or bought there. So the bulls are strong. They repulse this, preventing the bears from creating lower lows. Bears are failing. But while we were here, the bulls only had the opportunity to get to that level. And still the bears would have controlled the day. But now with this trading range that's been created, if the bulls are strong enough to break out above it, we are going to get to a new high, higher than the high of yesterday. So all of a sudden, the structure of the day is potentially going to change. So then you have more confidence to hold on to your longs. And all we're using is just measured moves to have that story told us. Okay? So you take a trade, stop down here, and you hold on to your bull trade. Then you see this, it's a very strong bull channel. I love the fact that when you really start to understand price action, there's no noise in the market. When anyone says there's noise, humbly respect them, but they do not understand price action. There is no noise in the market. There is information. So what information are we getting here? Okay, we are still within a trading range. And we've taken a trade here. And we are hoping that the bulls who are creating all of this price action are strong enough to break above here. Okay, which would mean also strong enough to break above here. Now, this level, I marked it. So, when you start the day, you mark the high of yesterday, the low of yesterday, you mark the midpoint of yesterday, because that's a key level. Because if the bears in this case are able to keep the market below the midpoint of yesterday, it means today will be a bad day that controls yesterday. Okay, because this is yesterday's range. Okay, and 50% of that is there. That's the midpoint, where forces are balanced. So if bears are able to keep the market down here, they've controlled the day. If they're able to keep it above there, or if bulls are able to go above the 50% point, then they are in control. So that's a key level that you're also watching. So as far as the bears are concerned, if you're just saying, okay, I made some money selling on the open, made a little bit of money here, got out break even, I am going to wait. And if you wanted, you could have sold off here, and you're hoping to get a breakout, because as long as you're beneath the 50% point, you are happy. That is fine for that case, because until the market breaks above it, you still have a valid case. But our measured move is telling us right here that if the bulls are strong, they're going to break above the 50% point. They're going to break above the open of the day, okay, which is almost the high of the day. Then they're also going to break above the high of yesterday. So if you're in the bear case and you're going to take any shorts, you have to be super careful about your trade management. I would not be once we have a setup for the bulls. Okay, best to just change your mind and say, okay, I'm going to be buying. If you can't do that, if you've made money, don't worry about it. Leave it, come back the next day. More information is being provided for us here. This tight channel, two-sided price action, dodges, bull candle, doji, bull candle, bear, bull candle, doji, bull candle. But look, out of whatever, 2, 4, 6, 8, 10 bull candles, only one of them is a bear candle, and it's all in a tight range. Anytime you have a small pullback trend, very small pullbacks, that is, if you were to look on the 15-minute or the hourly chart, that would be one huge bull candle. Okay, so that means coming off this entry here, the bulls were exceedingly strong. They did not allow the bears to pull back the market. Okay, though the market trend did not get to a breakout point, but this bull strength, if you are in a bull trade, do not exit your trades. Okay, you can't ignore this is bull strength. Why can't you ignore it? Because if it's bull strength, anytime we have a pullback, the bulls are going to try and continue the upward trend. So with that in mind, you can say to yourself, hang on a second, I see that strong bull trend. It starts there. And that's almost its high, somewhere there. Let me look at the pullback. So the market pulls back to there. Okay. Market pulls back to there. So you're saying that's the first leg because that's very strong. Market is pulled back and tested the low of yesterday. Very good information because our case is now bullish. There is the low of yesterday. If the bears were strong, no matter what the bulls have done, they're going to smash through that to demonstrate strength, rather create a trading range for the rest of the day. But they don't do that. There's a perfect test that takes place here, and you get another opportunity to go long. So if you hadn't taken a trade here, you have to take a trade here. I mean, your stop is still down here, but that's where you have to take a trade. If you took a trade here and your stop is here, when you see this bullish strength and the pullback that tests the low of yesterday and the second entry to go in, add into your position right here, but now your stop is here. So you have a tighter stop. Okay, that you must take. You cannot ignore that. And again, another reason that you must consider that is that if the bulls achieve their objective, they are going to close above this trading range, and they are going to test the midpoint of yesterday. So opportunities to trade, just looking at measured moves, when you see that taking place, you have to take that trade with all these levels that we've seen where the bulls want to go take a trade, put your stop here. Now, you're taking this trade, whether it's the first trade or the second trade, you've seen these lower highs here that have been created, and that's the lower high. But now you're saying, okay, starting from here, if the bulls that created this tight channel here and the pullback, if they're strong enough, okay, which they're showing strength so far because they've prevented a break beneath the low of yesterday, then they're going to have to do a measured move above this forming trading range. So again, we go. Fibonacci retracement. Now we're looking at this high and that low where we get into the market. Okay. So again, confirmation that the bulls want to get to test and maybe just break above the midpoint, which would completely create a new, a higher low from here. Okay. So confidence for you to take a trade, don't put your stop here. Okay, put your stop at the technical position down here. Right. So now we wait and see what happens. So again, strong bull trend off the entry point. Why am I saying strong bull trend? Because you can see very little pullbacks, almost the same as that. Okay, so the bulls are strong and they get to test that high. Okay. Okay. We know where we're coming from. So now we have that high. Okay, you've taken that trade and you're saying, well, I know there's a level of resistance here, but I'm waiting for the measured move to get up there. Right. So you got to hold on to your trade unless you have a clear reversal. You know, if the market has to come down with bear candles down here, there will be some kind of a pullback. You know, let's get out break even. But hold on to your trade at this stage because you're hoping to get to that measured move. And also don't forget this measured move here. Okay. Which was based on just starting, we started there. Always go for the nearest levels. You could pull that down to that level, but that's extra sweet profit. So we have another level just up here from that first leg pullback, and we're anticipating the second leg. We also have this measured move here for this little trading range. So all staking up to say, keep taking the longs, you know. If the market then reverses from here and comes down, fantastic. Now we get to this level, strong bull trend, we can't ignore that. There is another strong trend there. Okay, get to this side, double top, market tries to turn, two strong bear candles, good for the bears. But if the bears are strong, I mean, not much point giving a strong bear candles above the moving average when the market is going up. Okay, we want to see strong bear candles breaking beneath here, pull back, then we say, oops, the bears are back in control. They might smash through here, then I can close my trades. But have a look at it. Strong bear candle, followed by another bear candle, then a doji right at the moving average. Level of support now, okay, because the bulls are creating these breakouts that's pulling the moving average up. Doji, small candle, the thick one is a 10 EMA, the lighter one is a 20 EMA. The bears fail at the 20 EMA. Then we have a low test candle, that small candle, and a decent enough reversal. Beautiful. If you're still not in a trade and wondering why this market is going away and say, my goodness, what do I do? You can take a trade there. Your stop is now here. Okay. So if you've taken a trade here, and your first stop was here, when we took this next trade, we move our stop to here. Okay. If you want to take a trade here, your stop is here. Even if you do not take a trade there, you can move all your stops up to this level. That's the correct place. And you are still hoping and anticipate the market may get to a measured move. And guess what? Another little measured move is created here. That high and that low. Everything is saying to you, that's the area where you might be considering taking profits. Okay. So you can take that trade, stop here, and hopefully get a one-to-one. You could also, in fact, not you could also, you must also put our leg 1 equals leg 2, the expansion. Remember, we started off here. So that low, so there is a breakout and it started there. So that whole leg you can look at. First leg. And there is a pullback, and you go to where the pullback is. Again, level of resistance. So nothing stops you from taking a trade here. And if you wanna take profits, I think I've said this enough. If you're gonna be watching your trades, so if you're gonna be going away, so you gotta go and do something, go do a chore, go to work, whatever the case may be, on this chart or any chart that is set up like this, these measured moves, the other useful thing for them is for you to take profits. Okay, because now you can see a whole stack of hidden resistance levels. So measured moves show you hidden levels of resistance. You set your take profit in here on all of these trades and say, okay, I gotta go, I'm gonna set my take profit here. And if the market gets here, just bank my profits, and then I'll come back an hour later and see what happens. Okay. If you trade like I do and you sit on your charts throughout the day, I don't set take profits at all. Okay. I leave it because I want to observe, I want to manage my trade. I put stops. I always have stops in the market, and I always trail my stops to the technical level. So now when I get to this level and I see bulls coming up, then I see bear candles in the trading range that is forming. Guess what? I'm not panicked because I have been tracking all of these levels of resistance throughout the day. And I know that in this area, there has to be profit taken because that's where the measured moves are. That's where the primary goal of the bulls were. So in this zone, so all of our measured moves, in that zone of the measured moves, that's where you take profit. So this trading range price action market going sideways is simply profit taking. That's what's taking place. But when profit taking takes place, it means some of the bulls who were buying all through here are selling. But at the same time that the bulls are selling, the bears who created this big breakout earlier on in the day, and the bears who opened up here because the market gapped up, okay, the bulls pushed it up, but the bears came in from the open and sold it off. So the bears who had the open here and who created this breakout are defending this whole area because the bears want this area to the bulls to fail. So that's why you have a trading range created huge forces in place. But now, whenever you see a trading range, whether it's a large trading range like this or a small trading range like this, it is always giving us information. There is no noise in the market. I could say that over and over again. Because if you look at it, now in the perspective of a bull, for like me for now, I'll be saying, hang on, I'm managing my trades. If the bears are strong and they break to the downside, then I'll get out of my trade. But I'm looking and I'm saying, okay, what is happening here? There's a pullback. Bulls attempt to resume. They fail. So we test in the midpoint of yesterday. Now we have that low. Bears come back. Bulls resume. They fill another low. So here I have a wedge pattern, a 3-push pattern. Very important clues for us because it means the bears tried 3 times, once, twice, 3 times to turn the market, and they have failed. If the bears have failed to do something 3 times, the market is likely, if the market has failed to do something 3 times, likely to try the other side. So when I see a bull resumption, I'm saying, okay, this is fantastic. Now the bulls are taking control of the market after the bears have failed 3 times. So the bulls are still strong, even in this little tight trading range. They've now created a higher low. Okay, this little double bottom here is a higher low to that. So as far as the bulls are concerned, they're still in control of the market. So they just want an opportunity to go long. Then we have this huge bull candle that breaks out above the trading range. Now, having seen all of this price action, when you see that breakout, if you're not in the market, that's a breakout that you must just take. You buy above that, because essentially you're looking for an entry after this wedge bottom, pull back, trying to find a way in. You get a candle, so you can get that. Now, breakout, good, but we're still beneath the open of the day. We have a follow-through candle, good, of that breakout, fantastic. Then we have another candle breaking above it. So this is a confirmed breakout. So the bulls have broken out above this trading range, above the high of the day, above the open of the day, and by this candle also broken out above the high of yesterday. And after that breakout, we want to see confirmation. So every time we have breakout, we have confirmation. Breakout above this trading range, confirmation. Breakout above open of the day, this candle, confirmation. Breakout above the high of yesterday, we have confirmation. Confirmation is any bull trend candle. Then immediately after the confirmation, we have a doji. A doji, as we said earlier on, is a pause candle. Okay, so now you got to go back and say, okay, if that's a pause candle, just like we had a pause candle here, where did the breakout actually begin? So for me to see how far this market is likely to go. So if you have a look at it, so that's a pause. That is our pause candle. So that bull body is the end of the breakout. Okay. And if we go to where the breakout began, that's the breakout. That's the actual breakout where it began. So that candle was above it. There is a confirmation of the breakout. We could look at the actual high of the trading range. From the high of the trading range to the pause candle. Okay, high of the trading range to the pause candle. The bulls want to get to a measured move up here. Or you could say, okay, that was the high of the day. So I actually think my breakout that I'm going to consider first is from the pause to the high of the day. Okay, so there is a pause, there is a breakout. The market is paused on that doji to the high of the day. And if I'm taking any trade, I took a trade here, I can take a trade here. If you take a trade here, remember, stop is here. If you not take a confirmed breakout beneath the moving average, but you can take a trade anywhere in here with the correct stop. And now you're looking at the measured moves to say, okay, the earliest profit I can take is here, but I'm going to watch it and manage it because maybe the breakout, the computers, the bulls are looking from here. That's probably how far they want to go to that high. Okay. We can also put our expansion tool. Okay. And we're saying the first leg of all of this after the breakout, there is the first leg up to the breakout point. Let's move this a bit. Okay, there is the first leg from the breakout point. The market has gone all the way up to this high. Then the pullback, the low of the trading range, somewhere within there. So first leg, pullback. So I know within this zone, if I use the yellow rectangle, within this zone somewhere, I'm going to be taking profits. Okay. So if you've taken a trade anywhere, correct stop, that's fine. Now you're waiting. If you gotta go away, just put your take profits and see what happens. You might have been, your profit have come in here. If you put your profit up there, you would not have been hit your profit target. Depending. If you left it open for the day, it would have been there and triggered in the next day. But another point, critical point here, having seen this strength and seen the measured moves, there's going to be profit taken here, just like we had profit taken here. if you're going to hang around up to the end of the day, because you might still get in the last hour of the day. If you look at this chart, the Hang Seng 50, you might get a couple of candles accelerating all the way up. You wait and see what happens at the 10 EMA, the 20 EMA. Okay, you could still take a trade here, easily take a trade here. And now you get to the end of the day, your goal is just to get to that high or your measured moves. Okay. All right, guys, I'm 1 minute over my session, but thank you very much. I hope you found the measured moves useful. Marlon, thank you. I know you're going to upload this. And guys, Wednesdays at the market with George, second Wednesday of the month is there next week. Next Wednesday, 8 hours in the market. I hope to see you guys there, live trade in the markets. Thank you, guys. Take care. We will see you next week. Thanks, Ellis. Appreciate it. Take care, guys. Cheers. Bye-bye.